Hello.
It's Maria again.
Hi, Maria.
Do you have any office hours?
I do. I mean, we're
Can
not
can
on
I
campus,
see
so we're not doing office hours on campus, but I've
some
scheduled
hours?
office hours. I've scheduled Zoom calls with other students. So if you want to set up something with me, just send me a note and we'll set it up.
Okay. Can I see you after this class for a few minutes or no?
After this class, yeah, I think it should be fine. Sure.
All right. Perfect. Thank you.
Okay, then. Hey, James, I see you out there.
Hey there.
Hello. Okay. Okay, then. We're recording. Let's get our screen up. Okay. Good evening, everybody. Welcome back. I hope that you all had a good day. Today's a big day. Why? Because we concluded a 2-day Federal Reserve meeting. We had a conference this afternoon, a press conference with Jerome Powell. And this evening we have President Biden's first address to Congress. So a relatively important day in terms of domestic activity. Let's start here then. On Monday, we looked at numbers from data from last week. We looked at jobless numbers, we looked at the labor market, and we looked at home sales. We looked at the Case-Shiller number. And today, we saw, again, I point out the Case-Shiller number and consumer confidence yesterday. And the headlines on the Case-Shiller was that all 20 markets that the index tracks, the largest metropolitan markets in the country, saw price increases last month. So again, prices surged 12%, which is the biggest jump since 2006, with a gain of $35,000 for median price homes, which is significant. The average price for a house in the country is about $325,000. Consumer confidence jumped to a 14-month high, thanks to COVID vaccines, more jobs, a strengthening labor market, and of course, a surging economy. All things that we've talked about over the course of the last couple of weeks as the economy continues to recuperate and the vaccine program gets fully underway. If you look at some of the headlines that I picked out from today, let's take a look at that. We saw that the morning started with stocks slipping as investors waiting a Fed decision. That's pretty typical on the day that there's going to be a Fed press conference, that the market's a bit jittery, waiting to see what the Fed chairman's going to say. We got more bad news out of India, which continues to break records on a daily basis, not only in the number of infections, but also the number of people that have passed away from COVID. So as the U.S. is gearing to open up, India is in the middle of what looks like a real catastrophe. Thankfully, the U.S. has stepped up and said it's going to ship millions of vaccines to India and do its part to try to stem the progress of COVID in India. On the continent, we got some important trade news because the Brexit trade deal got its final okay from the EU Parliament. It passed today. So, excuse me, after 5 years going back and forth, it seems as though we're just one step closer to the finish line on Brexit, which of course is a very significant step forward. And no doubt, legislators in the UK and at the European Congress that represents the Eurozone are breathing a sigh of relief that they have put that to bed. Now let's turn our attention to the Federal Reserve. Can anyone tell us, aside from what we see here, that the Fed said vaccinations plus strong policies that are supporting the economy have helped the economy, that it opts to continue providing support and plays down rising inflation? Can anyone give us any other color on today's meeting if you happen to have a chance to listen to it or had some time to read about it this afternoon before I jump in? We know that the Fed left rates near zero, so the Fed funds rate's roughly 25 basis points. They indicated that they're going to continue to buy bonds in the Treasury market at a rate of $120 billion a month in an effort to do what? To keep rates down. Can anyone tell us what some of the worries were that the Fed Chairman talked about today?
They expect inflation to be above 2%.
Well, I think that what he said, Jason, I don't disagree with you. What he said is that if inflation is above 2% here and there, it's not a big worry. That inflation can trend higher than 2%, which is the Fed's target rate for inflation, without prompting the Fed to begin tapering. What they're looking for is an average of 2% over a period of time. I think the markets have already priced in 2.5% inflation. But again, he was very specific to say that inflation trending over 2% is going to be okay, and the Fed is not going to look to raise preemptively. One of the questions from the reporters was whether or not it's time now to start talking about tapering, which means that the Fed would start to reduce its monthly purchases. Jason, do you have any color on that for us? What they said about tapering?
From what I recall, the sentiment is that they don't plan on changing any of their policy. They plan on continuing and supporting the economy. They recognize that it's still necessary. It's too early.
That's exactly right. Excellent. That's absolutely right, Jason. Everyone hear that? The Fed made clear yet again in another forum that the question was very, very, very direct with regard, is it the right time to be speaking of tapering? And he was very clear in his feedback, which is absolutely not. And as Jason pointed out now with a bit more color, their expectation is that inflation will not be a problem. It's muted. If it rises above 2%, that's okay, as long as the average over a period of time is 2%. But that continued support from the Federal Reserve, along with or paired with fiscal policy coming out of the White House, that's providing extraordinary support, is going to be critical, will remain critical going forward for the foreseeable future. He talked about one of the worries, one of the concerns being supply bottlenecks. What does that mean? Slowdowns, shipping slowdowns, the inability to source raw materials, the inability to complete a manufacturing process. Those are the types of bottlenecks, getting raw materials and goods from point A to point B, that he was talking about, supply chain disruptions that have been a key feature of the COVID pandemic. He talked about the strengthening labor market. In fact, he talked about the services sector and how the services sector is really starting to rebound. However, he did point out that there are more than 3 million people that are still out of work that were employed in the services sector before the pandemic began. He also pointed out that although the labor market is recuperating, we're still at 6% unemployment. There's still way too much slack in the labor markets, and that we've got 8.4 million more people out of work now than we had exactly 1 year ago. And so that, of course, remains a concern, further buttressing or strengthening the argument that the Fed remains vigilant and will keep rates low, continue its bond buying program, and doesn't expect any of that to change in the foreseeable future. I don't have any comments on the Fed. I'm looking at my list of comments that I wrote down, comments I took. Anyone else got anything else for the Fed? The market's reaction was relatively muted. We were down about 0.5%, down about 160 points on the Dow. I wouldn't make anything much of that in terms of reaction to the Fed. I think that he's doing everything he can, Jerome Powell, along with his team, to keep investors confident in the direction the Fed is taking, and to remove as much volatility from investor thinking as possible. Any questions or comments here on indicators? I made a note the other day that we looked at labor and housing on Monday. We continue to look at the Case-Shiller today, consumer confidence. We've often referred to manufacturing numbers, oil as an indicator, the yield curve, interest rates, consumer confidence, consumer sentiment. These are key drivers of the domestic economy. And whether you're looking at the US or any other domestic market, these are key things to consider. In particular, though, in the US, which is such a key consumer market. I wanted to point out to you that tomorrow, again, we have jobless claims numbers on Thursday. We have GDP numbers coming out tomorrow. That's important. We'll sure to talk about that on Monday. And on Friday, we have consumer sentiment, which goes along with consumer confidence, which we got yesterday, as along with inflation numbers, which is very important. So GDP and inflation, along with some jobless numbers and inflation numbers coming in the next 2 days. I wanted to point out to you. We talk about indicators in the housing markets. One of the things that came up the other day was the monthly supply of homes. I wanted to see what the monthly supply of homes looks like over the course of the last 3 years since 2019. When inventory is below 5 months, it's considered a tight market. And in a tight market, we call that a seller's market. And as you can see here, the inventory of homes have been trading down since 2019, most precipitously since the beginning of the pandemic at the beginning of 2020, where we see a real drop in inventory as people are scrambling to buy homes and the market's really heating up. As you can see, inventory still is well below where it should be if we were at a normal balanced market, but not so terrible that there needs to be any enormous concern. In fact, one of the things Jerome Powell said today is he doesn't believe that there's a bubble in the housing market, and that was important to hear. And as we said in class the other day, his expectation is that contractors and developers will pick up the slack and deliver the inventory that needs to be in the pipeline in order to bring up that monthly supply that monthly inventory number. The other number I wanted to look at was home ownership rate, which is another indicator we look at as a measure of health of the economy. What you see here, we look back here about 30 years, you see that beginning of the 1990s, prior to the period after the Great Recession, we saw enormous job growth. This was the longest growth period. This was the longest period of economic growth in American history up to that point. Yes, and we see home ownership really increased dramatically, you see, well past the dot-com recession in the early 2000s and just peaking before the Great Recession. Yes, and we see that after the Great Recession, home ownership rates have dramatically have trended downward. They've recovered improved since the end of the Great Recession in 2010. What do we see now is that there's been a big hit in home ownership rates as a result of the pandemic. Here, we see home ownership rates suddenly taking a big jolt right here. The expectation is, though, that those will recover as the economy recovers. But again, home ownership rates and monthly supply of homes, along with existing home sales and new home sales, are all important barometers for the all-important housing sector in the U.S. economy. Remember, again, the correlation between the copper markets and the housing markets. Copper goes into a lot of things that go into homes. So increasing demand for copper dovetails directly into the housing market, along with the beverages market, along with the automobile market, along with the green energy market, all of the various industries and sectors that use copper as a fundamental component of production. Are there any comments or questions here? I'm going to move on then. We talked about the Baltic Dry Index, which is a measure of the cost of shipping dry bulk materials like coal and iron ore and grain around the world. And all we looked at on Monday was a 1-year snapshot of the Baltic Dry Index, which is a critical component of global trade. Why is it such a critical component? Because manufacturers see the end user, the consumer. When the consumer begins to slow down, when demand begins to slow down, the manufacturer sees that. And what does the manufacturer immediately begin to do? Draw down inventory and adjust his or her production schedule. That's going to have an immediate effect on the order of raw materials. The ordering and shipping of raw materials requires a lot of lead times. There aren't a lot of ships, and there isn't a lot of capacity relative to the amount of demand that there is. And so therefore, it's a very direct, it gives us very direct insight into the state of demand when we look at the Baltic Dry Index. And as we saw the other day, it hit a peak, a 19-month peak. As it turns out, the very next day, it ran to a 10-year high. Why? The BDIs you see here in the headline that came out yesterday rises to a 10-year high linked to Brazilian iron ore exports as key markets replenish supplies. What key market are they talking about in particular that's replenishing supplies of iron ore? The key market is China. So let's just take a look at this for a minute. We see that the Baltic Dry Index, that a recession has been predicted every single time the BDI hits new lows. So here, before the 1987 Black Monday stock market crash, we see that the BDI had its first low after having been introduced in 1985. 12 years later, it hits a low here in 1999 that predicted the crash, the dot-com crash in the early 2000s. Now we have in May 2008 up here, we see a record high level since it was introduced in 1985. And by November of 2008, it had reached its lowest level since 1986 with operating costs approaching break-even level. What happened in the fall of 2008?
Wasn't it financial crash?
The
Housing
beginning of the
crash?
financial crash. The beginning of the financial crash. Lehman Brothers declares bankruptcy in the fall of 2008, goes belly up, and then we're off to the races. And we see that the Baltic Dry Index at the same time is plummeting. And what follows this period of 6 months, this 6-month period between May and November was a long recession. So again, the BDI predicts an oncoming recession. And then again, we see here there was a sharp decline in the BDI in late 2009, early 2020, signaling again, as it has since inception in 1985, another recession. So in your toolkit as global manager, the Baltic Dry Index is an important one to have as a measure of what global demand is really looking like. Yep.
So the index hit the lows before.
Pardon me?
The index hits the lows before the recession or before?
The index hits the lows before the recession. It hits the lows before the recession.
Okay.
Okay. So now I wanted to take a look at the oil markets we haven't talked about in a while. So on the top, we first began in February. We immediately talked about the oil markets as a key barometer for the health of the global economy, certainly in the energy markets. On the top, we see what? We see the international benchmark Brent crude. On the bottom, we see the domestic benchmark West Texas Intermediate. We know at $40, that's a break-even level. What happens below $40? Below $40, oil producers are losing money. That's below their break-even. Yes? That's why we begin to see what? We begin to see rigs, oil rigs being furloughed, workers being furloughed as it becomes less and less profitable. In fact, it becomes unprofitable to drill for, produce, manufacture, sell oil. It forces producers to become incredibly innovative, also forces them to try to tap into new technology to drive costs down. Where are we now, though? Let's see. When we came into class in February, Brent was at 54 and WTI was at 53, 55. Now, if you look at the prices now in April, where are we today? We're about 20% higher in the domestic market and in the global oil markets. We're about 20% higher in both markets, which tracks with what we're talking about with the economy, right? So demand is increasing, BDI rates are increasing because there's more demand at the manufacturing level for raw materials. We see labor markets improving. We see the housing markets are very strong here in the United States. We see oil prices rising, oil prices both here in the US and around the world, even though we know there's lots and lots of oil. There was an abundance of oil, and prices are rising. Why are prices rising? Prices are rising is because the economy is beginning to expand again. The economy is beginning to experience a surge in demand, and of course, that's going to lead to higher prices in the oil markets. So again, whether we're looking at the yield curve or looking at oil prices, all of these indices are doing what we'd expect them to do based upon everything we know about an economy that is emerging from a deep recession, which is exactly what's happening. Are there any questions here on oil prices?
Yeah, did the US slow their operations doing fracking since Biden got into office?
I have no indication whatsoever that the Biden administration has done anything with regard to fracking. The only thing that would affect fracking is if suddenly it became unprofitable to do so. I'm going to not give you a longer answer to a short question. My answer is no, I don't think there's been any change. I think the change that has happened is, as we noticed in our first slide at a Congress today, it's been made public that the Biden administration is going to put back in place the methane restrictions, the restrictions on emitting methane gas that were rolled back under the Trump administration. Because what we know, because we follow science, is that methane gas only contributes to the devastating effects of greenhouse gas emissions. And therefore, it's incumbent upon producers to try to curb their methane gas emissions. So in terms of what the Biden administration has done, I know that they're trying to get out of agreements that were made under the Trump administration to allow for drilling in the Arctic. In ANWR, what's ANWR? Anybody? ANWR? The Alaska National Wildlife Association Reserve. It's about 19 million acres of the most pristine land in the entire earth that we use as a place to study. And under the Trump administration, the decision was made, well, why not drill there? Well, the reason you don't drill there is because it would disrupt what is a pristine piece of land that is incredibly important for research. And every single president from over the last 50 years, whether Republican or Democrat, has resisted the demand by oil companies to drill in ANWR because it's expected or believed that there's a huge deposit of oil in ANWR. Anyway, so my understanding is that the Biden administration has sued to have those agreements overturned and has come out and made clear that they're going to put back in place methane gas emission limits. So Guy, I'm sorry I don't have more for you on that, but that's going to have to do it for the moment.
Fantastic.
I want to take a look at, I want to do a quick review of where we were on Monday talking about the multinational. We know that the whole point of pursuing greenfield investments or subsidiary development around the world, whether it's acquisitions or greenfield investments, the idea is to try to optimize profits through a subsidiary network, and that companies want to exploit factor inputs. They want to exploit access to new markets, access to new technology, access to cheaper labor, access to new types of management skills. And so when we talk about the multinational enterprise, the idea behind it is that it allows for global resources to be allocated more efficiently, moved from lower to higher productive uses. That is, the US moves manufacturing out of its market, its domestic market, into other low-cost markets around the world. What we see is a positive reallocation of resources from lower to higher productive uses. We talked about different types of integration. We said that all that integration means is that you're acquiring some piece of the supply chain, either before the manufacturing process or after the manufacturing process. And what are you trying to exploit? All the things that we talked about before, along with the ability to develop scale opportunities, scale economies, to specialize, and to exploit comparative advantages. And so there's backward integration, there's forward integration. Backward integration just means that the company is acquiring the supply chain before the manufacturing occurs. So we use the example of the oil company, the oil producer that's acquiring all of the drilling equipment and operational capacity that happens before the oil company refines the oil and sells the oil forward into the consumer market. Forward integration is the exact opposite, where the company is acquiring the supply chain after the manufacturing occurs. So we use the example of the car companies. They manufacture the cars, and then they establish subsidiary networks in order to sell the cars around the world. Okay. We talked about horizontal integration, which just means that you're selling identical goods in different markets. Coca-Cola sets up factories in various parts of the world to exploit comparative advantages in each of those markets, seasonal opportunities, and produce exactly the same thing. Conglomerate integration means you're diversifying into non-related markets. The other day, we were trying to come up with some names of good examples. One of you came up with the LVMH, which is a very good example of a conglomerate. I thought another one is Amazon. Amazon is a very good example of a conglomerate that is investing in not just the shipping. I mean, when Jeff Bezos began, what was he doing? He was selling books out of his garage or his mother's garage back in the late 1990s. And now they're flying people to the moon and they're selling food on the corner at Whole Foods, along with all the other things, cloud computing that he's gone into. So this, of course, would be a very good example of conglomerate integration. We also pointed out that with regard to transfer pricing, that one of the tools that companies use is the allocation of profits between different subsidiaries that may not be based on competitive pricing, but rather based on the effort to minimize taxes of the multinational. And of course, that's one of the challenges that governments face around the world, which is chasing multinationals that evade taxes. So whether it's Burger King here in the US that has, through an inversion, a tax inversion, re-domiciled in Canada and pays a fraction of what it was paying before, even though it generates most of its revenue in exactly the same places it generated it before. Or companies are able to zero out their tax bills entirely by, through transfer pricing, allocating profits into low-cost tax domiciles around the world, which gets us back to another one of President Biden's proposed initiatives, which is to establish a global minimum tax that would hopefully minimize this type of transfer pricing. Are there any questions here? Okay, just a quick review. We talked about the key sources of conflict. They're quite intuitive. Well, if a multinational is going to come in, think of Nike going into Ireland. If they're going to create employment opportunities in Ireland, well, that's great, and that's exactly what they did do. If they're going to take away employment opportunities, well, that's a bad thing, and the host government's going to be less likely to welcome the multinational into their country. We talked about the source of conflict can be because of the transfer of technology via the demonstration effect and the competition effect. Demonstration effect is just merely commenting on the interaction between a multinational subsidiary and local firms. And what does that look like? Is that a positive experience or negative experience? We expect that it's a positive experience as a multinational comes into a host nation and is looking to succeed, and therefore is going to bring along all of its latest skill sets and latest technology and be willing to interact with local companies in that local market. What is the competition effect? Well, competition can be good or competition can be bad. A multinational coming into a host nation that is going to compel domestic firms to fine-tune their operating strategies in order to be more competitive, to innovate. Well, if that helps everyone bring up their game, well, that's going to be a good thing and will be encouraged by the host government. If, on the other hand, the competition is going to be such that it boxes out domestic producers, well, then, of course, that's not going to be welcomed by host governments, and there will be resistance to welcoming a multinational that promises to bring along competitive effects that are considered negative for the nation. Which gets us right to our next point, which is the idea of national sovereignty and the concern of nations that welcome multinationals and wonder what is going to be the economic and political policy impact of the multinational coming into the country. Will the multinational try to influence domestic politics as we've seen before? Will the multinational try to evade taxes? Will the multinational abide by the rules, regulations, and laws of the host nation, and not do anything that is going to threaten the sovereignty of the host government? Those, of course, are reasonable and appropriate concerns. The other source of conflict that we identified was with regard to the balance of payments, the inflow and outflow of capital. So we said that U.S. exports represent a positive factor. Why? Because you have money coming into the country, as opposed to direct foreign investment is a negative factor because money is leaving the country. That's a capital outflow. And so what lawmakers are required to think about when they think about structuring their trade policies is they have to think about the short-term static effects of the inflow and outflow of capital against the pardon me, against the long-term positive effects of trade, long-term positive effects of inflows and outflows on trade and on a company's earnings. I'm just looking if I'm missing something here. No, it's fine. Are there any questions here? Again, the balance of payments immediately identifies your current account, your capital account, and your foreign exchange balances. We then turn our attention to direct foreign investment, and we identified revenue-related motives, cost-related motives, and incentives that governments use to encourage direct foreign investment. We said that revenue-related motives are, well, like we said before, companies want to exploit their comparative advantages, they want to enter new markets, they want to pursue international diversification, and they want to react to trade restrictions. Cost-related motives include using foreign production factors, which is where we started out in the beginning of the semester, the idea that globalization allows companies to tap into low-cost labor markets and various skills at a lower price than they might otherwise be able to get in their home market all over the world. And so along with tapping into foreign production sources, a cost-related motive for direct foreign investment includes reaction to foreign exchange changes. And then, of course, to the opportunity to build scale economies in a variety of host nations around the world, which is exactly what, again, I like the example of Nike in Ireland that went and built a huge scale capacity in Ireland with the support of the Irish government that did a lot to encourage the direct foreign investment of Nike. What are the types of things that governments can do? Well, of course, they can provide money. Money is usually a big incentive to companies. How does that money appear for the company? Well, it can be in an abatement of property taxes for a period of time. It can be all types of tax incentives or research incentives, or like we said, an elimination or delay of property taxes. It can be a delay of taxes. There are a variety of monetary incentives that host governments can devise to make it attractive for multinationals to set up shop in their home country, Any questions here? Okay, so this is a review of where we looked at next the DFI sequence map, and we said basically that the company is going to identify its comparative advantages, develop its scale economies, and then it has to decide whether it's going to produce at home and export, or it's going to produce abroad. If it's going to produce abroad, it has a variety of potential pathways in order to make money. It can either produce via licensing contracts, it can produce via a joint venture, or it can pursue a wholly owned affiliate that looks either like a direct acquisition or greenfield investment. What's the difference in these various pathways? The difference is the level of control that a company has. They'll have the least level of control with a licensing agreement and the most level of control with a greenfield investment. So now we take a look at the pathways going from licensing on to establishing new foreign subsidiaries. Let's talk about them. So licensing, we know, obligates the firm to provide the technology, copyrights, patents, trademarks, and trade names in exchange for fees or other specified benefits. So your company is going to give access to your copyrights and patents to a company in Asia that's going to produce and sell your goods, that they're going to then pay you a fee on, a license fee, okay? It allows firms to use technology in foreign markets without a major investment or transportation costs. That's a big plus about licensing. What's the big disadvantage about licensing is that it's very difficult to ensure quality control in the foreign production process. And there are many examples of companies that have relied on licensing and have lost their way and have seen their businesses falter because they haven't kept an eye on quality Licensing has led, we've seen, as I said, many examples where companies have suffered because of poor quality. Okay. We talk about franchising. You buy a franchise like a McDonald's franchise, and well, that obligates the parent company to provide some type of specialized service or strategy and support assistance. The franchisee, you, the buyer of, let's say, the McDonald's franchise in Asia, makes an initial investment in exchange for periodic fees that you pay to the parent, in this case, McDonald's. So again, it allows you access to foreign markets without a major investment. So we looked at licensing and franchising. Next, we talked about JVs, and we said joint ventures are jointly owned and operated by two or more firms and allows firms to exploit their mutually beneficial comparative advantages. What this doesn't say is that the big problem about joint ventures is what? Finding a partner that you can trust and finding a partner that you can work with and rely on when things get difficult, as they often do. Well, of course, there's always challenges in business, and finding a partner that you can live with through those challenging times as well as through all the successful times is a challenge, but of course not impossible. The key question is about doing your due diligence. Finally, we talked about a direct acquisition of existing operations along with a greenfield investment as two types of opportunities for companies to exert the most degree of control when they're pursuing direct foreign investment. And so here we see that the acquisition of firms abroad allows a company to develop market share quickly. You're buying a company that's already in the French market, it's already on the ground. You're a New York advertising company, you want to expand your advertising reach in Europe, and so you're going to acquire an existing operation in Paris. It allows you, that already has market share in Europe, so that allows you immediate access to an existing market. That's an example of a direct acquisition. So, of course, it's going to be subject to greater risk because it's a larger investment. The more control you have, whether it's through a direct acquisition or through a greenfield investment, building from the ground up, the larger the level of risk that you're taking. But of course, the potential is for greater reward than you might otherwise have with a franchise or with a licensing agreement. Of course, liquidation can be difficult if a foreign subsidiary performs badly. In our hypothetical, the New York-based advertising company that buys a Parisian-based advertising company, if things don't work out well, it may be difficult to resell that asset, which of course could represent a significant loss to the parent company. Finally, we talk about the, we talk about establishing new foreign subsidiaries where the firms can enter the markets by establishing a new operation in a foreign country. The example we used at the beginning of the semester, which I like to go back to, was BMW in Spartanburg, South Carolina. We know it requires a large investment to set up, but was potentially less than buying an existing firm. For BMW, why was that so?
They were going to acquire some Ford assembly lines, I think, but they opted not to. It was cheaper.
That's right.
Start from ground up.
That's exactly right. And the reason was, Alec?
Repurposing the assembly lines of Ford. It was more expensive than.
It was not only more expensive, but fraught with potentially more problems. That's exactly right. In other words, I don't want to buy your problems. I want to just start from scratch. And that's exactly the sentiment that BMW arrived in South Carolina with in the mid-90s. The attitude of they wanted to do it custom tailored to their specifications as opposed to acquiring what could be a problematic existing facility. Very good, Alec. Thank you. And so building new, of course, with greenfield investments, buying versus buying existing allows companies to be to tailor things to their specifications, which is just what we said. One last point is that foreign acquisitions and new foreign subsidiaries represent the largest portion of direct foreign investment, far and away than the combined footprint of joint ventures licensing and franchising. So DFI via foreign acquisition and new foreign subsidiaries is by far the most popular methodology for deploying capital in foreign markets. Okay? So now we talk about the things that companies can do once they've figured out how they're going to deploy their capital abroad, what they can do after direct foreign investment to reduce risk. So think of BMW. They've decided to deploy their capital in the US. They've got to just choose where they're going to go in this big country. Well, they choose to go to South Carolina for a variety of reasons. The available land, the available labor, benefits accruing to them from the state of South Carolina. So the choice of facility location is a way to reduce risk. Again, the more you control, the less risk you have. So we talk about the control of transportation, technology, your markets, your brand name. This, of course, is not unlike yourselves as students or graduating students, either working now or looking to get a new job or getting your first job out of college. You do everything you can to, in this digital world, maintain your own brand name. You are managing your brand name, your image, much like companies try to do in markets around the world. Walmart is a very good example of a company, along with Amazon, giant companies that control the transportations. They own the boats, they own the planes, they own the shipping, the means of shipping. They own the technology, they control the markets very, very fiercely. And of course, they control their brand name by protecting their patents and their copyrights. Certainly companies like Microsoft, all of the major technology companies are like that. And of course, this is a way to reduce risk after you've deployed capital abroad. Keeping a thin equity base and multi-source borrowing. We talked about that again with BMW, which could well afford to spend the $1.5 billion that was needed to build their facility in Spartanburg. They borrowed from multiple sources. Why did they borrow from multiple sources? In other words, their equity was the equity that they put out was much lower than what it could have been. They borrowed from a consortium of local banks. Why did they do that? Anybody?
I think it's cheaper to get debt than equity, and also, yeah, that's the main reason, I would say.
Okay. Anyone else? Why does a big wealthy company come and borrow from lots of banks? What's its objective?
It's also less risky for each of the banks to lend.
It's less risky because you can spread the risk around a consortium of banks. You can syndicate the loan. That's exactly
Yeah.
right. That's a very good point. But what about creating goodwill? What about creating stakeholders in your success? BMW comes in and says, I don't need anybody. I've got $1.5 billion, $2 billion. We're going to spend it all on our own. We don't need any help. We're doing it all on our own. Much better to come in and create an infrastructure network, an infrastructure network of contacts, of business relationships, of lenders, of suppliers, all of whom are now engaged in the success of BMW doing well in Spartanburg, South Carolina. Does everybody understand that, I hope? It's about creating goodwill, creating stakeholders in your success. Much like you do in your job search and in your efforts to improve your professional standing and in your efforts to progress through life, you're always trying to create goodwill, whether it's with your professors, your friends, the people you encounter on the street, the people you interview with, the people you work with, so on and so forth. It's exactly the same concept on a large level. So getting back to reducing risk after DFI, of course, using local labor is a key strategy. Yes, why use local labor? Well, not only do you benefit from the support of you're creating stakeholders among the local citizens, but there could be enormous benefits to absorbing the skill sets of local labor. Okay, again, a really good way of establishing goodwill in a local community. Another way that companies can reduce their risk is to use a short-term time horizon for their cash flow recapture. So they might say it's going to be 3 years instead of 5 years. That puts everybody on notice. that pushes everybody to keep a closer eye on the bottom line if the understanding is we've got to recapture our initial investment after 3 years as opposed to 5 years. Okay?
Professor, I have a question. Is political risk also involved in this, and how can a company like reduced like
Well, that's exactly right. There's always political risk. There's ongoing political risk when a company is deployed capital abroad, whether through franchising, joint ventures, licensing, greenfield investment, or a subsidiary. Absolutely. And that's a constant job to maintain a good relationship with local authorities, to be in about be in I'm trying to think of the phrase, to be in accord, to be within the regulations of the host government the host country that you're operating in, to follow all the rules and regulations. All of these things help to reduce political risk. These are enormous concerns, particularly in countries where there are issues of corruption. So yes, this can be a very tricky thing to master. And in fact, we know that there's insurance products that are offered by the World Bank and by the and OPIC, Overseas Private Investment Corp, here in the United States, to help reduce the risk of political insurrection and political problems abroad. We're going to get to that in just a moment. So we talk about another strategy, which is using project finance, which is non-recourse funding. It means that they can't come after you personally. That's secured with the future cash flows of the project. It's often used with projects that are involved with natural resources. Finally, getting back to the comment I think that Maria made, companies can take insurance from OPIC or MIGA, which is the Multinational Investment Guarantee Agency, which is the version of OPIC from the World Bank. So we know that there's inconvertibility insurance, which is you can't convert to a local currency. You can't convert local currency. So you're in Singapore and you need insurance because you can't convert your local currency into dollars. You're in Myanmar or some other far-flung outpost where you have an operation, you can't convert the local currency. There's expropriation insurance, which is when the local government seizes control. Pardon me. Like we see in Venezuela, when the government of Venezuela has stepped in and has seized control of oil operations of, for example, ExxonMobil, and said your oil company is now the property of the state of Venezuela. And so, of course, they had insurance against that type of seizure. There's war, revolution, insurrection, and civil strife insurance that protects against physical or financial damage. And then there's business income coverage, which provides coverage in the event of lost income due to political violence. Okay, and so all of these are very real and very helpful to address political risk, as you just pointed out. Thank you. Okay, so now we talked about how to get to DFI, what path to choose, what the different paths look like, what companies can do to reduce the risk after direct foreign investment is made. And now we talk about what the barriers to direct foreign investment are. The first one is protective, where government agencies can prevent a multinational from acquiring anything if the multinational poses a threat to local employment. Red tape is a barrier to direct foreign investment because the more red tape it is, the more difficult it is to pursue DFI. So that refers to procedural and documentation requirements. There can be industry barriers. What does that mean? That local barriers that have government influence exert pressure to prevent the introduction of foreign competitors into their home markets. That can be a tremendous source of resistance for multinationals looking to do business around the world. There are environmental barriers to direct foreign investment. So there are building codes, codes with regard to the disposal of waste, and of course pollution controls that can be very good for the environment, but not so good when it comes to attracting business. And so what legislators need to do is balance the needs of the environment against the needs of business. And sometimes the needs of business suffer a bit, increasingly now, perhaps justifiably so, because the fact is that the environment is suffering. And in order to protect future generations, some companies, although they fight about it, have had to accept a little less profitability because it costs them a little bit more to dispose of their toxic waste, and costs them a little bit more to put up a building where they need to abide by or adhere to strict building codes, as opposed to what we saw in London. We talked about the Grenfell Tower disaster, where people burned to death because the government was looking to incentivize low-income housing. They got the low-income housing, but unfortunately, developers cut corners and they weren't held to high standards. So there weren't fire doors, there weren't smoke alarms, there weren't sprinklers, and well, people died. 80 or 90 people died. So the hope is that environmental codes may be a barrier to DFI, but they're essential for a safer future. Other barriers to DFI, of course, include regulatory issues. It gets back to the same concept. Companies don't want to be constrained by regulation. Unfortunately, regulation is necessary to prevent abuse. I'm not saying that there needs to be too much regulation, just enough regulation. And so constraints can be with regard to taxes, convertibility of currency. Don't forget there could be capital controls in place where government doesn't allow countries to repatriate their money, doesn't allow them to convert their money, their local money. So there's no deliverable forward market. If there's no deliverable forward market, what do? You can't get money in and you can't get money out. There are dozens of countries right now that have in place capital controls that limit the inflow and outflow of foreign capital. We'll get to that in a week or so. We talk about non-deliverable forwards that we use to overcome local currency controls. We talk about ethical differences as a barrier to DFI. Of course, things like alcohol and predatory lending, gambling, things that might be considered okay in one country that aren't considered okay in another country. That's going to be an impediment to DFI. And finally, getting back to Maria's very astute observation with regard to political instability. This is a major concern for direct foreign investment, is that there's oftentimes abrupt changes to the policy of a local government that can result in the seizure of your company, like we saw with Exxon in Venezuela. That's an extreme example, but it's because of extreme cases like this that we have insurance available to us through OPIC and MIGA in order to address those concerns. So yes, political instability, political volatility, political conflict is a major concern when moving capital around the world. Okay. So now, barring any questions, excuse me, let's see. I'd like to talk about country risk. Country risk is a tool that companies use all the time to evaluate various countries in order to deploy their capital. There are a variety of methods used to evaluate country risk. They've been consistent for many years, and I want to go through them with you now. It's all very intuitive, you'll see. So if questions come up, please ask. So the questions we're asking are, what are the common factors used to measure country risk? How is it measured? And how do companies use country risk analytics to make their financial decisions? So there are multiple assessment methodologies. We're going to talk about those that are used in order to measure country risk. The first one, the most popular one, is the checklist approach, where we're taking risk-weighted financial and political factors that are ranked and weighted to derive overall risk. It's based on the International Country Risk Guide, which, believe it or not, has been published over the course of the last 40-odd years out of a company in Westchester, right here in New York, okay, that's sent out all over the world to global managers around the world. It's published monthly. It covers risk factors in 140 developed, emerging, and frontier markets, and is considered a Bible for country risk, or evaluating country risk. So you have the checklist approach, the Delphi technique, which is merely the collection of independent opinions Quantitative analysis, which as you would expect is just regression analysis. You're measuring the sensitivity of one variable to another variable. How is a particular company going to do in a particular market if there is a recession? How is a company going to do in a particular market if there is an expansion? That type of thing. Inspection visits. What does that involve? It involves meeting with government officials, local business executives, and of course, consumers. Finally, we consider the micro assessment and the macro assessment. The macro, pardon me?
Professor, for the inspections visits, do they have any framework that they used or any
No,
no?
they don't. In other words, what most companies do is they use a combination of these approaches, the checklist, Delphi, and quantitative analysis. They use a combination of all of these. Yes?
Of a specific
Come
period,
with a decision. In terms of inspection visits, if you imagine it's BMW, they're coming into Spartanburg, they want to meet with local officials, they want to meet with local business executives, they want to meet with consumers to get a sense of what's going on the ground in South Carolina before they deploy $1.5 billion worth of capital to build a facility there. There's no hard and fast rule about how inspection visits are supposed to take place. It's a guide.
I see. Okay.
So a macro assessment represents overall risk and is consider all the variables except those which are firm specific. So that should be very easy to understand because it's just macro issues, as opposed to a micro assessment, which is an assessment of the country as it relates to the company's specific business. Okay? So, are there any questions on these techniques? Okay, let's take a look here. This is an example of the ICRG, the International Country Risk Guide. These are risk factors, and we get risk-weighted financial and political factors from the ICRG guide every month. And these are examples of all of the risk factors they take into consideration. And you see what I've highlighted, things like bureaucracy, civil war, consumer confidence, financial transfer risk, literacy, non-tariff barriers, GDP, repatriation, which is currency controls we talked about, poverty, unemployment rate, war, external conflict. All of these things are ranked and weighted every month by the RCIG. They're ranked every month by the RCIG.
Is there any overall grade?
If the ratings are on a scale of 1 to 5. So the ratings are on a scale. The ratings are on a scale of 1 to 5, with 1 being the best value and the lowest risk, and 5 being the lowest value and the highest risk. These are the countries that participate or analyze. These are countries, all of which have all of these factors and more analyzed every month by the ICRG, which is why I said it's considered the Bible of country risk. So let's take a look at how the checklist methodology works. Okay, so first we identify the risk factors and we assign the values that are based on the ICRG. So every risk factor gets rated by the ICRG on a scale of 1 to 5. 5 being the lowest risk and the best value. 1 being the lowest risk and the best value, and 5 being the
highest?
No, I misspoke completely, and I'm sorry about that. Yeah, 5 is the best value and the lowest risk. 1 is the lowest value, the least value, and the highest risk. So 5 is what we're shooting for. 5 is the best. 5 is the best, as you would expect. I conflated that in my mind. I apologize for that. So let's take a look at an example. So in this case, the company is looking at an investment in Singapore. In this case, it was looking at an investment in Singapore. And there are all of the hundreds of risk factors that the ICRG ranks. It chose political and financial factors that were relevant to its business. So on political factors, there were consumer attitudes, the host government actions, the blockage of funds transfer, so currency controls, war, inefficient bureaucracy, regulatory constraints, and corruption. The financial factors included interest rates, exchange rates, inflation, GDP growth, industry competition, and finally, trade balances. So once we've ID'd the risk factors, we have to assign factor weights based upon the independent or internal analysis. So in other words, we use the ICRG guide for the 1 to 5 for the ranking of 1 to 5. 5 being the best, 1 being the worst. Yes, and then the company itself has to decide what is the weight of that particular factor, and that's all done internally. And then from there, we derive political and financial risk weightings, multiplying the factor values by their weights, and we derive the overall country risk score and the cumulative political and financial risk weightings. So let's look at an example. So you see here in the legend on the bottom left, 5 represents the best value and the lowest risk. 1, of course, is the lowest value, the highest risk. In this case, to deploy capital in the Philippines, the minimum hurdle rate, the minimum score was a hurdle rate of 4. So unless the company comes out with a rate of 4, then they're not going to pursue the direct foreign investment based upon their analysis using the ICRG guide. So here we talk about, we're looking at blockage of funds transfer. The rating was 2, which meant that there was a real issue with capital controls in the Philippines. The company said that this was 40% of the political risk factor. So that gives you weighted value, 2 times 40% of 0.8. Bureaucracy was the other issue, and that had a rating of 1, meaning that was that had a very poor rating. The assigned weight was 60%. So of the 2 issues that they relied upon, capital controls and bureaucracy, the weights were 40 and 60% respectively. You see the weighted value comes out at 0.8 and 0.6. So the political risk rating in total was 1.4. Does anybody not understand how that was calculated? The rankings come from the ICRG guide here. The assigned weights come from the firm. And then we just calculate the weighted value and the risk rating. Then we do the same thing with financial risk factors. You see here, we have interest rate, inflation rate, exchange rate, industry competition, industry growth, all of which these rankings were taken from the ICRG guide. The company decided what the weights were. It decided that the exchange rate was the most important thing. Inflation, industry growth, and industry competition were the next most important things. And then interest rate. And then we calculate it through, and we come up with our financial risk weighting of 4. So what do we have? We have overall political risk and overall financial risk of 1.4 and 4.0. So now the company says that the political risk is 80% of the risk that they anticipate deploying capital in the Philippines. And financial risk represents 20% of the risk. And all that we have to do now is calculate it through. We get our overall rating, we add them up, and we have an overall country risk score of 1.92. In which case did the company make the investment based upon this analysis?
Yeah, it seems reasonably safe.
They didn't
Okay.
make the investment, right? Because
Alan, why didn't they make the investment?
Because the country risk score was lower than the hurdle rate of 4.
Thank you. Thank you. That's very good. Thank you. Thank you. Thank you. That's exactly right. I'm glad to see you have your thinking cap on. That's fantastic. Yes. In other words, the hurdle rate was 4. Unless they achieve a minimum of 4 doing their checklist approach, using the checklist approach methodology, they weren't going to pursue the investment. In fact, they didn't pursue the investment because it came in well below where it needed to be. This is one way to take the guessing work out of it by relying on an industry standard guide, like the ICRG guide. Okay, so that right. So he said the country risk score is less than the so no direct foreign investment. We have about 10 minutes left. I'd like to do just a little bit of hedging with you, if we could. Not as much as I'd hope, but just a little bit. Before I let you go, before we move on to the hedging though, I'd like to just mention that, in fact, I'd like you to do chapter 9 homework. You have all the information needed on multinationals to complete those problems. There are 10 easy questions. Please do that. Please do that work, and you should have read through the assignment in chapter 11 for next week. In our final number of classes, we're going to be doing hedging, and I will post the answers to chapter 9 homework on Monday. But I encourage you to do it all on your own before. The work that we've done here in the last couple of sessions, you should have no problem answering those questions. In terms of hedging, I want to take a quick look again at what we did the other day. It's super important. We talked about interest rate parity, which tells us that interest rate differentials between nations are reflected in their forward premium or discount. And we talked about purchasing power parity. It just says that relative purchasing power should be the same whether you're buying goods at home or abroad. And then we looked at the purchasing power parity exchange rate. I'm sorry, I'm jumping ahead. We did look at the purchasing power parity exchange rate, and we looked at the Big Mac example. We looked at a Big Mac, the cost of a Big Mac in euros in Paris, and the cost of a Big Mac in dollars here in the United States or here in New York. And we came up with the purchasing power parity exchange rate. We compared the implied spot rate based upon the cost of those Big Macs in Paris and New York to the actual spot rate. And what we found was that the dollar was in fact undervalued against the was undervalued against the euro. Why? Because we found that the implied spot rate, excuse me, just bear with me for a second. The implied spot rate was 99 cents. The euro bought 99 cents, and the euro spot rate was $1.20. So that meant that on the ground, my euro gets me only 99 cents, but in the market, my euro gets me $1.20. Something's wrong here. The euro is undervalued and the dollar is overvalued because the capital market should reflect what's going on in the markets on the ground. That's the point. The implied spot rate shouldn't be less than the actual spot rate. It should be the same. And if it's not the same, that means there's an adjustment that's going to take place. From there, we talked about the International Fisher effect, which did what? It's a groundbreaking thing. He developed a very powerful forecasting tool, said that spot rate changes are due to inflation differentials between countries, and that nominal rates have two components, a real return and the expected inflation rate. And using the formula for the expected forward premium or discount, this puts into our hands a very powerful tool for anticipating cash flows in the future based upon foreign exchange rates. We know that foreign exchange rates adjust in response to inflation expectations, but Fisher made clear in his analysis that it wasn't a perfect adjustment because of differences in trade balances, regulation, growth, macroeconomic, and geopolitical issues. So in our closing few minutes, let's take a look at a couple of examples here. So I'm telling you to compare the implied versus the actual spot rate to determine if the dollar is over or undervalued using the exchange ratio, the implied over the actual -1. So here we have the dollar-yen implied spot, giving us the dollar is buying $1.02, is buying yen 102.64, and then the actual spot rate, the dollar is buying yen 113.67. So what's going on here? We're seeing that the dollar is buying fewer yen in the local market than in the capital markets. So that means that in the capital markets, the dollar is overvalued and the yen is undervalued. How do we determine exactly what it is? We just set up the ratio as follows. The implied spot rate over the actual spot rate -1 tells us that the yen is undervalued against the dollar by about 10%, and that the yen should appreciate against the dollar. Let's take a look at one more example. So here you have the dollar against the Swedish krona. The implied spot rate is 1091. Is dollar buys krona 1091. the actual spot rate is the dollar buys krona 9.05. So the dollar is buying 10.91 in the local markets, but the dollar is only buying me 9.05 in the capital markets. So what does that mean? It means that the dollar is undervalued and the krona is overvalued. So all we need to do is set up the ratio as before, krona over krona, and we get the implied over the actual, and we get the dollar, the krona is overvalued against the dollar by 21%, and the krona is expected to depreciate. Does everybody understand that?
So Professor, when we first did this problem, I wasn't clear what the actual is another name actual spot
It's the
rate?
spot rate. It's just the spot rate. What is the spot rate? The spot rate today was dollar krona 9.05. But if you look at the Big Mac, in Sweden as opposed to New York, we come up with a dollar krona implied spot of dollar krona 10.91. So in other words, my dollar is buying me more krona on the ground than it is in the market. It shouldn't be that way. So that means that in the markets, the dollar is undervalued. The dollar should buy me more krona in the capital markets.
Got it. Yeah, I was just a little bit confused with the
The
actual.
markets, think about that. The actual spot rate is just the spot rate. What is the capital market saying? What's the euro exchange rate? What's the dollar ruble exchange rate? So on and so forth. The implied spot rate is based upon looking at similar goods in two different markets to come up with an implied spot rate based upon the price of those similar goods. Do you understand?
Similar goods. Okay, perfect. Now it's okay. Got it.
Okay. Okay, everybody. I had a couple of more hedging problems I wanted to go through, but we're not going to have time for that tonight. I'm going to stop the share. I'm going to say hello to everybody. I want to wish everyone a good continuation of your evening, a safe end to your week, a good weekend ahead. Again, please do Chapter 9 homework over the course of the next 5 days. We'll post answers for that on Monday. If any questions come up, please send them to me as many of you have been. And again, I want to wish you all a good, safe continuation of your week. Thank you all very much, and good night.
Bye, Professor. Professor.
Good night.
These notes will go up in the next hour, folks, okay?
All right, good night.
Good night.
Good night, everybody. Thank you.
Yeah.
Maria?
I'm still here. I'm still here.
Okay.
I was
A couple
afraid
of
you
minutes.
guys
Tell me what's up. You know, can we set this up for tomorrow?
I have classes until 9.
Okay.
Would that work? That doesn't work, right?
Okay. I'm going to remove these folks.
Yeah, I don't know who else. Just one more.
Yeah. Okay, it's just you and me. What's up?
Yes, Professor. Just
Hi,
you.
Maria.
I'm at the office now. Still at work.
Okay.
Professor. So, I think you're still recording.
Am I? No.
Yeah.
Oh,
Yeah.
okay.
It says it's still recording.